This is Macro Horizons, episode 384, The Silence Heard Around the Market, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Vail Hartman and Delaney Choi to bring you our thoughts from the trading desk for the upcoming week of July 27th. And in the absence of any forward guidance from monetary policymakers, investors are increasingly open to a July surprise as much as they see a cause for pause. If nothing else, it will be a Wednesday of worry. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market sold off rather sharply. It started on Monday with an upward drift in rates, primarily as a function of geopolitical concerns. This eventually translated into a rethink of the probability that the Fed hikes policy rates when it meets on Wednesday, July 29th. What is interesting is that the facts haven't necessarily changed per se, with perhaps the exception of a further escalation of tensions in the Middle East. Nonetheless, energy prices have definitively been on the rise, which has contributed to a more hawkish view of the Fed. This has all occurred in the week ahead of the Fed, which means that the communications blackout was in place and we didn't hear anything from monetary policymakers. That being said, monetary policymakers haven't been especially forthcoming in terms of forward guidance at the moment. Certainly, Warsh has not. It is also notable that in prior Fed regimes, one might have looked to the financial media for context on how the Fed was viewing recent developments. And in this case, the recent developments of note are the June inflation data, as well as the re-escalation of tensions in the Middle East. In terms of pass-through of higher oil costs to the end user, the average price of a gallon of gasoline is now, once again, above $4. This has recently been a bit of an inflection point for the White House, and therefore we wouldn't be particularly surprised to see some type of tone shift as it relates to the energy market coming from the White House during the week ahead, or more likely, over the weekend, given the way that the news flow and developments have been structured over the course of the last several months. In terms of economic data during the week just past, it was very limited. We did see a slight downtick in the pace of ADP weekly employment statistics, although comfortably in positive territory. And by way of contrast, we had a very low initial jobless claims print, all of which, if nothing else, has reinforced the market's perception that labor conditions remain solid and the U.S. employment market remains remarkably resilient.
It was interesting that we saw such sharp price action in the Treasury market in the week just past, given the dearth of fundamental data and the lack of Fed speak. We saw an escalation of tensions in the Middle East, and the market-implied odds of a rate hike rose above 35%.
To some extent, I think we're just seeing the realities of Warsh's efforts to scale back on forward guidance. Really, until the market has a clearer sense of the Fed's reaction function to the economic data, I think the market's going to be heading into FOMC meetings more wary of surprise potential and pricing in a higher tail risk of the non-consensus outcome.
And to some extent, one could argue that that's by design. Warsh has made it very clear that he's not interested in providing the market the type of forward guidance that had previously been the case. So to some extent, that is by definition going to increase volatility around Fed events. And we see that playing out in the price action itself. There's going to be a higher floor for nominal rates. And as we've seen in recent weeks, there also appears to be significant upward pressure on real yields. And it's a real yield story that I think is particularly interesting. We see this playing out in the 10-year sector as well as the 30-year sector. And there's multiple factors underlying higher real rates. First is the obvious and familiar fiscal argument. There's eventually going to be a lot of issuance in the Treasury market, and the notion is that real rates and term premium will be on the rise as a result. Fiscal concerns are not limited to the U.S. We can see this playing out in JGBs, in the gilt market, as well as to a lesser extent in boons and EGBs. Another contributing factor to the upside pressure in real rates is the notion that AI over the course of time will increase, not decrease, R star. Our operating assumption is that it will, over time, decrease R star. But the argument that seems to be running through the market at the time is that because AI will increase productivity, there will be higher profitability as well, which will also contribute to consumption, and over the course of time, real GDP will be higher. Now, the flip side to that argument is that there will be downward pressure on nominal wages going forward, which we suspect will ultimately offset any upside pressure on R star, because after all, robots don't go to the mall.
The long-term effect of AI on R star is certainly challenging to predict, and policymakers have outlined credible arguments for both higher and lower real neutral rates in the future. It'll certainly be interesting to see what Warsh's task forces have to say on the issue. Despite the elevated level of uncertainty around longer-term R star, I think there's a much higher level of confidence that short-run R star is higher in the current environment. Remember that while policy rates have been stable since the December FOMC meeting, realized inflation has moved higher, which has pushed the real federal funds rate lower.
And at the same time, the equity market has continued to outperform, which has subsequently eased financial conditions. And that's one of the challenges that Warsh is going to face. Because even if there is consensus on the committee to hike rates by 25 basis points on Wednesday, the reality is that it's just a quarter point, and overall financial conditions are going to remain relatively easy unless we see a material correction in the equity market. Now, it's also worth highlighting that if we look historically, the Fed has tended not to view a single quarter point or even 50 basis points worth of change in Fed funds as having a material impact on the real economy going forward. Instead, typically it's 3 or 4 quarter point moves that the Fed would define as a fine-tuning adjustment. So in the event that the Fed goes on Wednesday, we would expect the market to very quickly price in at least another 50 basis points worth of rate hikes by the end of the year, which, frankly, does complicate the Fed's decision. And in an environment where there is a lack of forward guidance and the market is still attempting to recalibrate to what might be a new reaction function on the part of monetary policymakers to the evolution of the real economy, investors would have nothing but recent history to look back on when considering whether one rate hike means 2, 3, or even 4 more, or if a hike is simply a one-off occurrence. The other argument against a one-off rate hike is that historically, monetary policy tends to be reasonably stable, all things considered. And if the Fed shifts into the mode of increasing or decreasing a quarter point based on 2 or 3 months worth of economic data, then that would only further contribute to volatility and uncertainty around monetary policy, which would, over time, undermine the Fed's credibility and increase the perceived risk of a policy error, especially given all the cross-currents that we currently see in the macro landscape.
And also in the event that the Fed does hike rates on Wednesday and lead the market to price in a more aggressive tightening campaign over the next 6 to 12 to 18 months, it would likely be accompanied by greater concern of policy error on the part of the Fed. Recall that over the past few years, one of the defining aspects of the macro landscape has been the low and stable unemployment rate. By raising rates in an inflationary environment, the market would be justified in revisiting the outlook for a stable unemployment rate and the potential for the consumer to begin to come under greater pressure as they are already facing higher prices at the pump.
And with gasoline prices once again above $4 a gallon, we're reminded that historically moves in gasoline prices have been closely correlated with consumers' near-term inflation expectations.
And it's interesting when we look at forward measures of inflation expectations, i.e. break-evens. Even 5-year forwards or 10-year break-evens outright have been remarkably well contained, all things considered. Part of that is going to be a function of the fact that while there have been isolated pockets of core inflation over the course of the last 18 to 24 months, the bulk of the reinflationary pressures that were seen during 2022 and 2023 have largely subsided. Now, admittedly, inflation is running a bit on the hot side, but we're certainly well below the pandemic peaks. There's also the aspect of Fed credibility embedded in contained break-evens. And frankly, the Fed has done a reasonably good job of reestablishing its credibility as an inflation fighter. And while it's challenging to characterize Powell as especially hawkish, the fact that the Fed did pause the process of normalization earlier this year has contributed to investors' confidence that the Fed will do what it takes to contain inflation. And then there was the introduction of Warsh, who has been decidedly more hawkish than the market had feared. Although I'll argue that he's more balanced than anything else, his efforts to focus on the 2% inflation target at his first meeting as FOMC chair was intended to signal to the market that he wasn't going to be beholden to the White House and come in and simply advocate for cutting rates. Instead, on net, he appears to be taking a balanced approach, although, to be fair, we'll have a much better sense of how balanced that approach is on Wednesday afternoon.
And beyond just the hike or no hike decision, Warsh's press conference and the policy statement, as truncated as it might be, will also offer another opportunity for Warsh to showcase his reluctance to offer forward guidance. After all, we're still waiting for the verdict of the 5 task forces.
Warsh has made it clear that his 5 task forces are currently in discovery mode, and so the market's been left to infer the possible findings and recommendations that could ultimately find their way back to the committee later this year. As for the balance sheet task force specifically, our general view is that there isn't a simple path toward a smaller balance sheet, and attempting to scale it back too quickly runs the risk of overwhelming the market with more securities than it can absorb. Frankly, this point isn't inconsistent with the Fed's current messaging that any shift in balance sheet policy will be well telegraphed and occur at a slower pace than many might have assumed before Warsh's confirmation to be chair of the Federal Reserve. What will be interesting to see is if the balance sheet task force agrees with Warsh's recent comment that there are several sustainable equilibriums that the Fed can achieve in terms of the smallest operational size of the balance sheet. Either way, the messaging from the chair is clear that any change will be deliberate, understood by the markets, and there will probably be quite a bit of time before any changes are operationalized.
One aspect of changes to SOMA and the Fed's balance sheet that has been debated in recent weeks is whether or not the Fed should consider reducing the weighted average maturity of SOMA. The argument to reduce the WAM of SOMA to match that of the Treasury debt outstanding certainly resonates when we think of a neutral monetary policy stance as it relates to the balance sheet. Reducing SOMA would more likely than not be executed by reinvesting less of the runoff further out the curve, 10s, 20s, and 30s, for example, and focusing investing in 2s, 3s, and 5s. The bill question is an open one, and if the task force makes a compelling case that SOMA should perfectly match the composition of the Treasury market, then given the Treasury Department's recent borrowing patterns, there would need to be a greater emphasis on bills. When we put this in the context of coordination between the Treasury Department and the Fed, it's certainly not wasted on us that the Fed would be reinvesting more in the front end of the curve at a moment in which the Treasury will continue ramping up borrowing in that sector. While one could be excused for viewing this simply as the Fed monetizing the federal deficit, the reality is that SOMA is significantly larger than it was prior to the pandemic and even before the great financial crisis. And if there were to be some market ramifications from monetizing the deficit, one would expect that to translate into a materially weaker dollar. And that simply has not been the case.
Yes, the balance sheet is gradually moving higher because of the Fed's reserve management purchases, but Kevin Warsh appears content to view these bill purchases as nothing more than routine plumbing operations that hold no implications for the Fed's stance on monetary policy. The messaging from the Fed is that the gradual growth of SOMA is purely a technical operation aimed at maintaining an ample level of reserves in the financial system, as opposed to a monetary policy decision that holds signal value.
So what you're effectively saying, Vail, is different pockets, but the same pants.
But one pocket might have a hole in it.
I know my pockets have a hole in them.
On the topic of funding, month end is on Friday, and while funding costs are expected to firm over the next few sessions, the repo market remains well positioned to absorb the expected short-term liquidity strain, particularly given the Fed's continued injection of reserves into the banking system to help maintain stable funding conditions. The pace of reserve management purchases has slowed substantially since tax season at the current pace of $10 billion per month compared to $40 billion at the beginning of the year. And currently, U.S. bank reserves are up by more than $200 billion since the inception of the Fed's bill buying program back in December. The Fed's decision to continue reserve management purchases in recent months, despite the ampleness of reserves and softer funding rates, speaks to the importance of the outlook for reserve supply as an input for the Fed's RMP decisions.
Ah, that's what RMP stands for. I thought it stood for reasonable monetary policy.
There's no such thing as reasonable monetary policy.
Is that your forward guidance?
I need to call a friend. In the week ahead, the macro narrative will be defined by Wednesday's FOMC rate decision. As it currently stands, the market is pricing in a 1 in 3 probability that the Fed increases policy rates. Now, this isn't our base case for Warsh's second meeting. However, we're cognizant of the risk that the Fed is willing to de-emphasize the June inflation data and instead look at the trend that was in place prior to the drop in headline CPI seen in June. At the end of the day, we think that there's a much stronger argument to be made that the Fed should keep policy rates on hold and focus on the September FOMC meeting as the potential liftoff for rate hikes in the event that the July and August CPI figures reveal a return of upward pressure on core prices. Recall that at the June 17th FOMC meeting, the Fed statement that was issued was notably shorter than the prior communications. We expect that that will be the case once again and look for the statement to be largely unrevised. The Fed will most likely retain the phrase that the committee reaffirmed its policy of maintaining ample reserves in the banking system, suggesting any change in the Fed's approach to its balance sheet will be a long time coming. Recall that the Fed's characterization of inflation was that inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The committee will deliver price stability. And with those two sentences, we'll argue that the Fed has said all that, frankly, it's willing to say about the trajectory of inflation at the moment. Now, the press conference will be a bit more interesting, and while Warsh has been unwilling to provide forward guidance, he has been willing to discuss the conversations and the debates on the FOMC as it pertains to setting policy rates. Recall that at the June meeting, the vote was unanimous, 12-0, and we're less confident that that will necessarily be the case for the July meeting, and wouldn't be surprised to see a dissent or two in favor of a rate hike in light of the renewed uncertainty based on developments in the Middle East and the response that has been evident in the energy sector. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as a friendly reminder, the last day to vote in the Extel Global Fixed Income Research Poll is Friday, July 24th. We would truly appreciate your support with 5 stars in our key categories of U.S. rates, technicals, fixed income, and short duration. And even if you missed the deadline this year, don't worry. We'll be back asking for your support again next July. Hopefully. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.